tax planning takes place 12 months of the year, not just April 15th. So these are some things you want to be proactive going through the course of the year.
And welcome into your game plan for retirement, your resource, ladies and gentlemen, for a common sense approach to planning for your financial, investment, and retirement future is president and founder of McIntire Retirement Services, Chris McIntire, serving proactive planners and savers across and throughout Northwestern Ohio. Always a pleasure to have Chris here on the program to provide insight and guidance. Chris, we certainly appreciate the time, and we are wrapping up tax season here, as you usually do, starting us off with a great tip of the week.
Yeah, buddy, we're just wrapping up the tax season here. It's fresh in everybody's mind that, tax planning takes place 12 months of the year, not just April 15th. So these are some things you want to be proactive going through the course of the year. And I have one pet peeve about April 15th being the tax day. It's awful close to my birthday, and so sometimes, we get April surprises that we don't like, and my birthday present gets smaller.
Yeah, well, a very young 61 coming up. Happy birthday. Congratulations, Chris.
Thanks, buddy.
Yeah,
Appreciate it.
absolutely, absolutely. Yeah, but you're right. Tax preparation is a day, is a season. Tax planning is an ongoing process. So when most people want to forget about taxes, that's the time to dive in and really make some progress and headway in controlling your tax bill.
Yeah, absolutely. We're here, kind of in the month of April here, the first quarter, and we're trying to be more proactive with our Roth conversion, folks. And I'm having more and more people ask about that as we have our meetings in the early part of the year, saying, "Hey, I spoke to my accountant. He says I got an extra $10,000 I could put into my Roth IRA," and I said, okay, so let's see if we can't find an opportunity. When's the best time to do that? And what I mean by that is, let's say Peter, you and I were talking about Apple stock before we turned on the radio recording here today. And so, if Apple stock fell 25% and you owned it inside your IRA account, you could move that stock over into your Roth or some portion of it and let it recover on the other side. And I think most of us would probably agree that Apple stock is probably going to go up, over the long haul versus go down over the long haul. And not that we're predicting.
Yeah, well, I think, Chris, the key there that you're talking about is that with a plan in place, and you're saying, hey, here is the intention to execute these kind of moves when everyone else is panicking because of recent market volatility that we've seen. That can be kind of a cue for opportunity if you've got the plan laid out and mapped out. And that's what we're talking about here with the process of tax planning. That's something that McIntire Retirement Services, you and your team pride yourself on helping to provide for your clients, where I think a lot of people have made the comment to me that part of the conversation is noticeably absent with their financial professional.
Yeah, and it takes a lot of time and effort. You got to coordinate sometimes with the CPA, and let's give you an example. So let's say somebody said, "Hey, I want to convert $100,000 of my IRA into my Roth." Okay, well, you have to pay taxes on that, and let's say it's 20%. So all of a sudden, your $100,000 just became 80,000. Your advisor makes less money.
Mm.
Okay? So sometimes that's the hidden gems behind it. And I think we've made that same example as saying, "Hey, I need to buy a house. I want to take a withdrawal of 300,000 out of my investment account." And the advisor says, "Well, why don't you finance it and we can make more money than that and we'll just arbitrage it." Right? So sometimes it's in your advisor's best interest, where we are fiduciaries. We must act in the client's best interest. And we've just had two clients bought houses here recently. And I said, do not take a mortgage. You have more than enough money here to take that out, because mortgage rates are 6 to 7%, depending on, the type of loan that you're getting. And why would you want to do that unless it's a incredibly large mortgage that, and you had limited resources.
Well, I assume that there's a time and a place and a rhyme and a reason and season where either solution may be appropriate. But Chris, as the fiduciary, your job helping clients weigh those options and figuring out pros and cons and benefits and disadvantages to either option, and then trying to arrive at the conclusion which is the best option for their specific situation. And I think that's important. Big box financial firms, you're an account number, ladies and gentlemen. That kind of personal planning, walking through the rest of the context of your situation, those big name firms where you call up to make a trade, they don't know the rest of your situation. They don't make those kind of recommendations. That's the difference between working with a true fiduciary versus having access to the market. And I think that is such an important, measurable difference in people's approach, not to mention the topic of today's program, which is going to be the tax planning angle, which again, a lot of people say they're not receiving from their traditional source of financial guidance and advice. So that is why Chris is here each and every week, and why he presents the opportunity to you, ladies and gentlemen, just for being a viewer or listener to the show, to get together your game plan for retirement. And if you would like to have that plan, the roadmap, the 30,000 foot view, you are here. Here's where you want to go. These are the steps to take to get there, laid out for you, no cost, no obligation. Pick up the phone and start the conversation with Chris and the team at McIntire Retirement Services. 419-332-0532, 419-332-0532, 419-332-0532. Not just a number, a real person, real situation, real circumstances, and real planning to help you achieve your goals confidently. Chris, if we are talking about here tax planning specifically being a process, where does that process begin? How do we start the conversation of putting a plan for taxes together?
Well, it starts with your tax return, okay? And then also step two is, okay, what type of investments do you have? IRA, Roth IRA, regular money. Just personally, my wife and I, we have IRAs, Roth IRAs, and, just a regular brokerage account. So some of those have different tax ramifications. So the tax return is pretty key there, because it tells you how much money or how much, tax we're paying on the interest that you might be earning from CDs outside of your IRA accounts. It'll tell us about, qualified dividends, non-qualified dividends. We won't go into all the details of all of that, but sometimes we call that passive income. I'm paying tax on these dividends and interest, but I'm not spending any of it. And can we, make those more efficient? It's hard to eliminate certain types of taxes. Like, my wife and I have, hundreds of thousands of dollars outside of our IRA account that generates dividends mainly for us. I'm not a big CD buyer, right? I buy stocks that pay dividends, and I pay capital gains taxes on those dividends, not income taxes. So, I know that's throwing a lot out there. I'll let you kind of segment that if you want, Peter.
Yeah, well, let's start with that tax return, Chris. For most people, the tax return is mostly about income, right? Where are your sources of income? What income is coming in? Because the highest level and the first level of tax that we pay is income tax, and then we get into those investment accounts. And as you said, we're going to segment this out here. But for people making the transition to retirement specifically, Chris, that top and first level of income tax, that changes significantly as we move from our working career to retirement. Can you talk about that and mapping and planning that out from a tax perspective?
Yeah, yep, absolutely. So got a client just recently retired, not even 59 and a half just yet. So, we had, we wanted to know how much income have you had this year? Okay, so let's just basically say through the first quarter, right? January through March. How much income have you had? And then, most of the money is in a retirement plan. So we had to say, okay, how much are you going to need to get you to age 59 and a half? Because we can pull money out of like a 401k before being 59 and a half, as long as you're over the age of 55. Okay. That's going to be a 20% mandatory tax withholding. Okay. Because it's coming out of a 401k. And I'm just saying, that's an example of, look, understanding where is the money. Most of it is in a taxable 401k account. We're going to do an IRA rollover and whatnot, but not being age 59 and a half presents a specific set of circumstances where people over age 59 and a half, they can typically make withdrawals from their IRA accounts, 401ks, and not have a 10% penalty. Okay. Well, if they need $200,000, does it make sense to pull out $200,000 in a lump sum to buy a house, for example? And tying this back into our earlier conversation from the show is, sometimes it makes sense to take a mortgage out and pay that house off in 5 years instead of 15, because you're pulling it out of a taxable IRA account. You might drive up your Medicare costs and a lot of other circumstances. I know that's a long-winded, example there, Peter.
Well, I appreciate it because, again, emphasizing the difference that somebody experiences when they're just an account number or set of account numbers versus when someone has an advisor. And studies of investor results over decades have shown that people who have advisors, like what we're talking about here, Chris, do better, keep more of their money, get better results. And I think that that is an important distinction when you're taking the individual circumstances of somebody's situation into account when making recommendations. It is naturally going to provide better, more optimal results. And that's why, ladies and gentlemen, if you don't have a resource with that kind of guidance, a fiduciary advisor, somebody who knows you and your circumstances personally, I encourage you to pick up the phone, give a call to Chris McIntire, McIntire Retirement Services. Just start with a conversation and begin to understand what that difference could mean to you. If you'd like to take it the next step, you can have a consultation, a strategy session. And again, Chris willing to put together the roadmap, the outline, your game plan for retirement along with you and for you, showing you steps to get to and accomplish your goals. 419-332-0532, 419-332-0532. But Chris, without a plan, making that transition into retirement, number one, a lot changes. I think number two, do you find that a lot of people are surprised by how much changes? Because number three, they have not, unfortunately, mapped out and planned and understood that sources of income and therefore taxation are going to change as they make this transition.
Yeah, without a doubt, Peter. And another specific example, brought in a new client here recently, had some money outside of his IRA account invested. And so Ross and I at the office, we looked at, before we made any investment changes, what were the capital gains implications of saying, hey, we're going to switch this into our portfolio from where it was before. We might be using lower cost investments and this and that, but there was a cost to sell assets, that might have capital gains. So we sold some of the assets that had losses to them, and then we sold some other assets that had significant gains to kind of neutralize that. And we will monitor that as we go forward over the course of the years to say, look, we can do this in lower cost, but we don't want to drive up your taxes just to save you 0.5% on the investment side. So, I mean, that's having the knowledge or the wisdom, because I'm turning 61, so we have wisdom now that goes along with knowledge, right? Wisdom is experience plus having some brains in your head. But those are some specific examples of how we can help individuals. And like you said, Peter, if you're dealing with a wirehouse and you call somebody and on the other end of the phone is somebody with that answers the phone on a headset and has never seen your tax return, how are they giving you investment advice if they don't know what the tax implications are? And some of them even specifically say, we don't give tax advice.
Yeah.
Okay? Well, what the hell are you paying them for then?
Yeah, I'm gonna put it another way, Chris. I've always appreciated the saying, "Smart people learn from their own mistakes," and it strikes me that making the transition to retirement, like we only have one shot at an ideal retirement. We don't want a do-over or whoops, better luck next time. But without a plan, it's guesswork, it's trial and error. We are literally going to learn from our own mistakes. But with an advisor like yourself, like Ross, like the team there at McIntire Retirement Services that have seen this transition over and over and time again, we are having the benefit of learning from other people's mistakes and what has worked well for other people, and the benefit of an experienced, qualified team of professionals there to understand how the financial world works, how the tax system works, and to map those out to give us, again, optimal results in our transition to retirement. And ladies and gentlemen, give a call 419-332-0532. Begin to figure out what that means for you, the difference and the benefit for your situation. So, Chris, the sources of income change. We go from W-2 or 1099 to suddenly we've got Social Security and retirement accounts and pensions and Roth distributions, brokerage accounts. So, step two in tax planning, looking forward, understanding how each of those sources could be taxed differently is part of the process there.
Yeah, yeah, without a doubt, Peter. And, we have a lot of people that we set up for that need a monthly income of, let's say, $4,000 a month. Okay. All right. If they have an IRA account, if they have a Roth IRA account, and if they have a brokerage account, what makes the most sense to where do we pull that money from? Some of the factors are how old are they? Where is their current income tax at between Social Security and pensions? And, what do they want to do with their money? Do they want to, spend it all in their retirement and they're not worried about leaving any money to the children? Or is their focus, I want to leave as much as I can to our children? Then we might spend down the IRA for mom and dad and transition the Roth IRA and the brokerage account to the kids because, hey, they may inherit that money when they're earning $300,000 a year and are in a 24% tax bracket, and mom and dad are in a 12% tax bracket. So a number of different factors. There is no one easy answer to, a one size fits all. It's particular to the individual, which is what's nice about working with somebody who sits across the table from you and can look at your tax return, can reach out to their own CPA or CPAs that we use if we have some questions, and then analyze the investments for, can we lower the cost inside the portfolio, which is certainly a good win for the client and also a good win for the advisor as well.
Key to understand the tax brackets, and it's not cut and dry. Our tax system is not so simple, Chris. I think a lot of people assume they're told, "Hey, you're in the 22% bracket," so that they're paying 22% taxes on all of their income. That's not necessarily the case. So part of tax planning, an essential part, I would think, you have to understand the tax brackets and our tax system and where opportunities lie.
Yeah, absolutely. And, I suppose you want to, try to be a genie in a bottle and where our tax is going to go into the future. And, I think we've said on the show here over the years is, when I do my educational events at the local colleges and I ask people, how many people in here think income taxes are going to go up while you retire? And overwhelmingly, people raise their hand. Okay. The fact is, taxes have come down significantly. So, now is a good time to do that tax planning, just in case. Obviously, we have different powers, after elections and, who controls Congress and the presidency. That could certainly have an impact on tax rates down the road. Right now, we are in a very favorable tax environment, especially with the passage of the one big beautiful bill last year, whether or not you like the guy with funny orange hair, on Twitter and whatnot, right? He's really helped Main Street by keeping taxes low for the retirees.
Yeah, gas prices currently maybe a different topic there, Chris. In all fairness,
on the short term, yep, we got to give that. I have a diesel pickup truck, so yeah, no one wants to pay $5 a gallon, and I have a boat that's getting ready to go in. But I make a joke. I'm like, said, boy, last year they had the the tariff discussion right around my birthday, and then this year we go to war right around my birthday. So I don't know if I can change my birthday or not. They allow that?
No more birthdays for Chris.
Yeah.
You stay young forever that way anyway.
And
Chris, to your point though, of where taxes are today, where they have been historically, if we look back after like World War II, the top tax bracket was 94%. And today, average tax rates would need to increase by about 30% just to get back to our historical averages. I know we feel like we're paying high taxes, but right now is really a moment of opportunity. Ed Slott, who has been dubbed America's leading IRA expert, he's a CPA. He's been called that by the Wall Street Journal, is talking about how we have this historic opportunity right now with these low tax rates. And in addition to that, it strikes me that right now the IRS is bringing in taxes from kind of three generations simultaneously. The baby boomer retired or retiring generation is withdrawing from those tax deferred accounts. That's one. Workers right now are obviously paying tax on their income. And then the younger people are saving for retirement more and more in these Roth accounts, paying taxes up front. And yet still, Chris, we don't have a balanced budget. We're running deficits and building debt. And one of the biggest risks to proactive and effective tax planning, as you said, taxes could go up in the future. Legislative risk if they change the laws on things. That is something that we're going to have to deal with. Is that something that you talk to your clients about there at McIntire Retirement Services? The fact that, these are not permanent forever opportunities. Some of these are just potentially limited time only.
well, yeah, no question about it. And estate taxes are one thing as well. Ohio no longer has an estate tax. And previously we did where, the farmer passes away and the kids have to sell the land to pay the estate taxes within 9 months. So, thankfully, it is a very pro tax planning environment that we have right now. But like you said, hey, that could certainly change. When Jimmy Carter was president, the income tax rate, top rate was 70%. Today it's 39.7, or 37%. I'm sorry. It had been 39.7.
The one big beautiful bill.
37%.
Yeah, brought it back.
But yeah, and you have to have income over $700,000 basically for a married filing jointly. So, that just shows you. And I don't know about you. I would never work that hard to give 70% of my money to the government. That's how the mindset has changed.
Yeah, well, I think that's why Ronald Reagan actually got into politics also, is like he was making so much per movie and realized if he made a third movie a year, he'd only keep 6 or 10% of what he was paid for it, Chris. So, yeah. We're talking here with Chris McIntire, president and founder of McIntire Retirement Services. We're talking about the benefit, ladies and gentlemen, of not putting tax preparation in a box during a season and forgetting about it, but actually being proactive, thinking about taxes into the future and planning for them and making sure that you've got a plan in place to control your tax liability. That is part of the game plan for retirement that Chris and the team there at McIntire Retirement Services put together for clients. And if you would like to see what that looks like, pick up the phone, give a call. It is a complimentary courtesy service free of charge for listeners or viewers of the show to put together your game plan for retirement. 419-332 0532 419-332 0532 419-332 0532. And Chris, as you mentioned, right now the top tax rate, you have to be earning over 700,000 or so to get into it. Saving in these tax deferred accounts for today's retiring generation has not been a mistake. Back in 1986, if we were earning much more than $70,000, we were in that top tax rate at 39%. So taxes have come down. It's just now is the moment to shift paradigm and the way that we think and begin managing that tax bill that we may have built up.
Yes, and and in this general conversation, this politicized environment that we live in is, part of the, you'll hear the arguments on, well, they need to raise taxes to pay the deficit down, or the government needs to spend less or something along those lines. But I mean, look how many millionaires have been created when they brought taxes down. So capitalism, and look at the tax revenue that has happened. There's more tax revenue coming in when people can have the money and spend it and grow the economy. So, and you got to find the right balance, obviously. I mean, there is that discussion, but just to try to depoliticize some of we talked about Ronald Reagan, we talked about Jimmy Carter,
Well,
we're
politics
fighting
and
against.
taxes go hand in hand, so I think that's a natural part of the conversation. Chris, I recently read an article, and I was astounded. I don't know the exact number, but it was over 1,000 new millionaires are created every day. And there's some, high number of millions of millionaires in America. So we are in an environment where we've been able to create this wealth, and yet still the question remains, and the number one top fear and concern of retirees: how do I know if I have enough? How do I know my money's not going to run out? Well, if we keep more of our money through effective tax planning, Chris, that's the same as having more, or shooting for higher returns, but with far less risk involved. And I think that's the key takeaway, is that, ladies and gentlemen, through tax planning, you can take away more of your money.
Yeah, you absolutely can. And IRAs are certainly something that could come under some sort of legislative issues, and they have in the past because, when mom and dad are passed away and that money's transitioning to the next generation, we used to be able to stretch those distributions over their life expectancy. So if mom and dad died in their 70s, and their kids were in their 30s, heck, they had 70 years to take that money out. Now they have 10.
Yeah. Well, I mean, a stark example, a real life example of legislative risk, right? Because, Chris, a lot of people had plans in place to stretch those IRAs, and then the Secure Act passed, and suddenly they can't. The rules are written in pencil. Congress has an eraser, so why not take advantage of opportunities now, ladies and gentlemen? And that's what tax planning is all about. Taxes, Chris, probably one of the largest known expenses that we'll pay in our lifetime. Interest on financing, taxes, potentially healthcare, inflation. These are things that will cost us money. One of those is controllable, and that's taxes. And yet most people are missing or overlooking that opportunity.
Yeah, absolutely, Peter. And it's nice to have a show about this, right in the middle or the end of the tax season here, so people can remember, hey, don't put this on the back burner and then revisit it in mid-December. These are some things you want to be considering out, throughout the year. Where are you allocating your resources? For those of you that are still working, do you start using a Roth 401k versus the traditional 401k? Those types of things.
And again, this is advice, guidance that generally you do not get from the wirehouses or the big box financial firms, where you are an account number, you can call up, you can execute a trade, you can deposit, you can withdraw. Fantastic. But access to the market these days has sort of been commoditized and democratized. That's not a stark service, but getting individual time and attention and guidance on how to utilize that access and the tools that are available to us effectively and efficiently. That's what a fiduciary advisor should be providing you, ladies and gentlemen. So pick up the phone, give Chris McIntire a call, see what that difference begins to look like. And the realization of benefits from that could mean the swing of tens or hundreds of thousands of dollars in a year or over the course of your lifetime. The savings with proactive, effective tax planning can be very significant. And because we've got a progressive tax system, the more you have, the more income, the more assets, the more of a difference this is going to make for you. So again, give a call, 419-332-0532, 419-332-0532. Specifically, you'd like a plan, your game plan for retirement, to show you how to generate more income, pay less in taxes, keep more of your money, align your investments with your risk and your goals, a personalized plan with diversified strategies, long-term vision. Pick up the phone, give a call to McIntire Retirement Services, request your game plan for retirement Retirement. 419-332-0532. Chris, always a pleasure having you here on the program. Thanks for the reminder. Tax season may be behind us. Tax planning is ongoing.
Hey, my pleasure, everybody. Thanks for listening. God bless America.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.